Hello, everyone. Happy Saturday morning. Hope you guys are having a fantastic day wherever you are. And thank you so much for joining us this Saturday on our Saturday stream here, sponsored by Elevate Equity. I'm Elevate Equity's owner and CEO and founder, Derek Clifford. And I'm so excited to be with you all today because today we're going to be talking about something that's probably fresh on everyone's mind. And that is what's going to happen with the economy going forward in 2021 and 2022 with the COVID economy and the post-COVID economy. So as you guys know already, I'm going to do a brief intro as to what is happening right now with the overall economy itself. And then we'll jump forward into like what the asset classes of real estate are going to look like going into the future from this year forward and also into 2022 based on what some of the experts are saying right now. As you guys know, COVID has kind of ravaged the economy, and everything that has to do with retail right now is really, really suffering. Office space has also been hurting too because of the health restrictions for people being able to gather in close spaces. Some more states and more countries than others. In my home state of California, for instance, there's a shelter-in-place order that is still going on, I believe. And so we're not even able to congregate in areas within 6 feet of one another. So that's really putting a hamper on restaurants and office spaces. And so we want to take a look at like how that's affecting the economy itself. Obviously, there's been a tremendous amount of jobs lost too. And so what is it looking like now going forward? Okay. So hotels, retail, office spaces, they've all been hit the hardest. But multifamily and industrial have been thriving. Everyone still needs a place to live regardless of where they are with what's going on with the economy, right? And industrial, because of the pickup of e-commerce and the fact that people still need to buy durable goods, all of that stuff has kind of shifted the demand more towards residential and industrial. Some of the things that aren't as deeply impacted as people needing to congregate. So this pandemic has really hit all stratas of real estate investing and also of through the demographics of the United States and through the world. So I pulled some research and I wanted to show you guys a few things that I found. And so I'm going to put some stuff up on the screen right now just to show you some of the things that I'm seeing. A lot of these experts have been predicting what's called a V-shaped recovery. So obviously, as the COVID pandemic hit, you saw the economy kind of take a nosedive, right? But as the economy starts to pick up, things have gotten a little bit different. Now we're at a point where we're starting to see the unemployment come back up and the GDP, or the gross domestic product, of what the country is spending and how much goods and services are being exchanged, or basically just the economy itself, is starting to recover. So based on this research from the first half of 2020, you can see that there was a nosedive. And as of right now, a lot of the research that I've been seeing has been showing a recovery has been following more or less this type of trend line. This is what the economy should have been doing as a baseline if it continued the trend back from the most recent expansion from the global financial crisis in 2008. Okay, so I think it's interesting to remember that it's called a V-shaped economy, where we're going down and then back up. Okay, so that's one of the things that's important to see. Another big impact that we've got to remember is debt. Right now, the United States has so much debt going on. We have levels, a ratio of the gross domestic product, or the economy itself, that is equal to the amount of debt that we've taken out. And that has never happened since World War I. So our debt is officially larger as a country than we spend and what we make and how we trade with one another in order to do business. So that's a huge amount of debt. And when you have that much debt, right, the interest rates are key, because with all of that debt out there, the interest rates, if it goes up a little bit, all of that debt starts becoming due at more and more costly amounts, right? So it's the debt level makes the interest rates very sensitive. And so we got to be careful of that. The other thing that you guys might be seeing too is that home prices are just going up. They're just skyrocketing, right? And the reason that that's happening is the demand for housing is still there, but the interest rates are either staying fixed or they are at historical lows. And so we have all of this printing of money that's pushing up housing prices, even though people may not really be able to afford it. So those that do end up affording it end up finding themselves in more space, especially in some of those tertiary markets and those markets outside of urban cores. And so we're starting to see a lot of people who are more wealthy, or more they have more cash available, starting to get even wealthier, and that's what's called a K-shaped recovery. And that's also what we're starting to see. And again, this has been pretty much seen for many, many years. Every other economy that we've had has also shared this exact same type of characteristic, where some of the richer, they have more money to deploy when the economy is lower, and some of the poor don't have that, and so they end up getting pinched. So when the economy drops, some of the people who have more of the wealth can take advantage of those opportunities because they've been saving, or they have the cash available, or the assets to be able to move things around to buy some of those things. And so their wealth ends up skyrocketing or going up, while some of the poor, unfortunately, their wealth gets inflated away, right? As we have more of those interest rates staying same. And so more money just keeps getting pushed into the system and into the economy more and more. And so the value of the dollars that either these low income earners are creating or making at their jobs, or they're saving away in a bank account, is worth less. Their spending power is less, right? And yeah, there's minimum wage things in place, but we can talk about that another time. But my opinion is that sometimes minimum wage may end up forcing the cost along to the customer who's actually buying the product. They'll have to pay more, and so the entire economy just inflates up. So that's just my opinion. And I should also point out here too, I should have said this at the beginning, that this is all educational, and it's just my musings and what I'm seeing in the economy right now today, and what I'm seeing as indicators, and kind of my knowledge from being in the space for a really long time. So as I talked about, the K economy is more likely to be continuing in this case. And what makes this different than the previous economy in 2008, because one might be able to say, all right, well, let's look at 2008. Real estate probably isn't a good place to go, because in 2008, the economy tanked, and the real estate was a driver behind it. But I keep emphasizing that this is a different situation for sure. And one of these graphics that I found, I'm going to go ahead and put this up as well, online, shows this pretty well, okay? And what it says is that real estate will remain attractive amid low interest rates, ample liquidity, and recovering economy. So some of the things that we just talked about before was, the demand is still there because people still need a place to live regardless of wherever the pandemic is happening. There is a lot of private money that's still pent up and hasn't been spent yet. There's a lot of equity in assets out there that are still waiting to be deployed. So it's not like the people that are owning all of this real estate out there are in a place where they're over leveraging and there isn't enough money for them to take losses and just let the whole thing go and the foreclosures start, right? So what this is saying is that over time, we have $335 billion worth of real estate private equity that's still in place. And it's at a very healthy level, almost double what we had in 2008. And then also we have all of these financial controls in place as well that kind of help all of us real estate investors feel more comfortable with investing in the asset class. Okay, so I just wanted to make sure that you guys saw that as well. Some of the other asset classes that we're talking about was like industrial. That is a really key part of the economy right now because of the e-commerce sales, such as Alibaba and of course Amazon. For those of us living here in the United States, that's becoming more and more important. And as those demand increases for people to get goods and services from Amazon, they need to have bigger storage spaces, and then the people that produce the goods, they need to have more industry. And unfortunately, it's kind of at the detriment of the retail economy because, I don't know about you guys, but me and my wife, like we would end up buying more things online than going to a store because we just can't do it because of the economy, right? And because of the pandemic. So because of COVID-19, we're substituting a lot of our retail shopping for more e-commerce. And so that's really what we're starting to see across the entire economy right now. And that means if you back it all the way up to the real estate behind what drives those economic engines, the space needed to produce those goods and services, and then the space needed to store them and logistically handle them to ship them out. That's all really, really important. And that's kind of what we're seeing here is a rise of those e-commerce demand. Okay. So that being said, I think I may have I talked a lot about what these asset classes are looking like, but now what I want to talk about is inflation, interest rates, and how printing money is going to be key. Okay, I think that as we go out of this, as we start to recover, the tertiary markets, the ones that are not in the urban cores, the ones that you have more space and it's affordable and cheaper to live, these markets have been changed forever now, because even though we expect to see some return of people to the office and working in high density urban areas to earn a living so that they have more money to spend and they just want to live in an urban area, those barriers are starting to fall down as employers are now a little bit more comfortable with keeping things fully remote. So those options will continue to be out there. And so people will start to gravitate towards finding themselves in situations in tertiary markets, like cheaper markets such as Indianapolis, Boise, Idaho, which actually isn't so cheap anymore. Some areas of Utah, all these pockets across the United States where it's just cheaper to live. I think that's going to be an effect that we're really going to see. And as real estate investors, if we can track the demand, right, wherever this demand is heading, then we can take advantage of that by getting ahead of it and putting some money into those assets and then letting the demand drive the increase in the value, okay? And again, I think inflation is important to this, and so is cheap interest rates, because without cheap interest rates, you don't have the easy movement that you do when people are inside of an urban core and they want to buy a house for the same price that they're renting an apartment, right, in the outer outskirts of the economy and of the metro areas. And so, if you have cheap interest rates, then it makes sense because you can have some of those easy transactions happen. People find houses that are the same monthly payment as they are making in rent. And why would you not do that? To have your own space and have your own thing, and you can still work remotely fully. That's something that's really interesting. On the other hand, the remote work thing may not be completely solidified, because there are some demographics with young kids at home, and then depending on where you live, that might not exactly come to fruition because working from home might not work out to your advantage. But all I'm saying is that there is an effect that's there. And whenever you have a mass number of people in the United States that may be moving towards that direction, then you're going to see an effect somewhere, especially in target markets across the United States. Because if we're seeing that effect and people are moving to maybe 5 or 6 really good markets across the United States, if you're going to buy in one of those markets, you have the ability to take advantage of the entire nation moving into those markets. And so the numbers really kind of work out in your advantage. And all of this works as long as the government keeps printing money, because again, and this is in some of my previous videos and Saturday streams that you can find in my Facebook tribe, but as money gets printed, people who own assets that are backed by debt, by fixed debt, are going to take huge advantage. That's why on that K-shaped recovery, that some of the people that are investors rather than consumers, people that have assets, they've got fixed debt behind the property, and the property will continue to go up in value, quotes in air quotes there, because the dollars that is being produced now is worth less. So when you make income, or you're collecting rent, or you're working your job, your income will go up, but the debt behind the property that you bought stays fixed. So it's interesting to see that, and I think that that's going to be a key thing. We have to keep seeing that low interest rate and inflation in order for this effect to really continue to take off as it is right now. And then I want to go ahead and paint a visual picture for you guys as well on what I was just talking about. I forgot to do that here, so I'm going to do that now. So this was the previous graphic. Here are the top 10 post-COVID-19 environment market cities to invest in the United States. And all of these areas, or at least most of them, are areas that we would consider to be tertiary markets, markets where it's cheap to live, the real estate is abundant, and the cost to build is still the same price, but in order to buy a property out there, it's not as expensive. And I'm happy to see right here that one of my primary markets to invest in right here is Indianapolis, and that's one of the top 10 markets to invest in. This is according to National Association of Realtors, which is mostly driven by single family data. But what happens with single family data can also be applied to multifamily data as well, just because most people would rather buy a single family home than rent, but it's just mostly looking at the demand. And that's always what interests me the most, is what the demand looks like on the other side. So I think this is a super cool graphic that the Association of Realtors put together. So that's a really good one. The other thing I wanted to show you guys is cap rates. Okay, so for those of you who are new to commercial real estate or valuation of businesses in general, there's a formula that says that the value of any property out there is equal to the net income coming in from the property on an annual basis. So whatever you profit from the business by holding it for a year, divided what's called by a cap rate. And this is like just a multiplier. It's usually like 4%, 5%, 7%, 9%. And so if you're making, $50,000 a year off of a business, if it's a 10 cap, then you divide it by 0.10, which is 10%, and that puts the business at a valuation of 500,000. So if someone was going to buy it from you, that's how much you would charge. So if it's $500,000, you're purchasing a business for that produces 50,000 in income, in net income, that's a 10 cap, right? And so what we're starting to see is that as cap rates go down, then values of the properties go up. And so we're seeing a pretty healthy decrease in cap rates, at least for the multifamily segment. And right now you can see that that is clearly below all of these different types of asset classes, that it's the most in demand right now. You can see hotel obviously has been struggling. It always has been pretty high, but right now it's seeing the highest cap rates as well. So that may pose an opportunity for people to buy hotels and maybe convert them to apartments or something creative like that. Okay. And then one final thing that I wanted to leave you guys with here is that there was a question. This is done by a CBRE research paper, which is fantastic, by the way. I'll also post the link to this paper inside of the Facebook group and also in some of the comments out there on the internet. And this is asking a bunch of experts out in the commercial real estate space how long they think it's going to be before investment activity returns to pre-pandemic levels. And you can see here, industrial, very, very bearish. Or bullish, I should say. 1 to 3 months, they think half of the correspondents say that they will be recovering to pre-pandemic levels. And since this survey was done in 2020, I believe that they're confirmed as of now. I think that we have, for industrial, recovered all of our pre-pandemic losses. And 3 to 6 months, 11 and 12 months is exactly. Multifamily is the next in line to be healthy, and then suburban office, retail, and then these are core business development offices inside of urban centers. They obviously have been suffering. Cities like San Francisco and New York have really been hurting because of the pandemic, and it's kind of trickling through. So people are moving out, and it's just really, really hard for them to recover some of those losses as all the jobs go outside of those major cities. Okay. And then the last thing that I wanted to share with you guys in terms of multifamily is that the multifamily industry, everyone wants it right now because everyone needs a place to live. And as population continues to rise, nothing is going to be changing. So we're expecting to see a 33% increase in the entire multifamily investment industry in 2021. That's $148 billion worth of investment. And that means that there's a demand right behind it. And as you can see right here, Midwest and Southeast regions will continue to outperform and provide good investment opportunities, which is excellent because that's the area that I'm advising most people to be looking to start their searches if they're going to be investing in real estate. So with that, you guys, that was pretty much everything I wanted to talk about here. And of course, if you have any questions at all, please reach out to us. Inside the description of the video, you can get a hold of our 7 ways that commercial real estate investing can help preserve wealth for you and build wealth for you. And it's totally free. Just go in there and click the link. Or if you want to learn more, I have a book as well. It's right above my head. I can't do that. And you can just search my name on Amazon and that book, the book title should come up. It's called Part-Time Real Estate Investing for Full-Time Professionals. Or you can just visit us on the web and listen to our podcast where we bring in fantastic people who are already way, way ahead in their field in real estate investing, and we can learn a lot more about what they do and their tips and tricks and how it works in a relationship, how they're able to hold their entire life in balance while investing in real estate and crushing it. So with that said, you guys, thank you so much. I've already taken up enough of your Sunday morning or Saturday morning, and so I want to return the weekend back to you, and I just want to thank you so much for listening. And again, if you have any questions, please reach out. We're here for you. We want to help. Thanks, everyone. Have a fantastic Saturday.